It's actually initiated by the Treasury, not the Fed, but it involves operations between the Treasury and the Fed. And I mean, they could do a reset that doesn't involve going back on a gold standard. They can just they can increase the official dollar price of gold. And that's a mechanism where they would be able to get more money in their Treasury general accounts without associated increases in debt. And therefore, they could spend that into the economy without debt issuance. And so they could technically do a big, say, dollar devaluation relative to gold, and kind of reset a lot of debts. That's kind of one of the kind of the debt jubilee mechanisms that they technically have, although it'd be a huge political lever to pull.
Did you know the US government has a secret weapon to reset the economy that could potentially devalue your savings overnight? Financial expert Lyn Alden reveals a startling mechanism. By increasing the official dollar price of gold, the Treasury can flood the economy with money without issuing new debt, triggering massive inflation. This strategic move could drastically reduce the value of the dollar, making your hard-earned savings and investments worth significantly less. Imagine waking up to find your financial security eroded, with prices skyrocketing and the cost of living soaring as the dollar's value plummets. Your purchasing power could be slashed, and the economic landscape could shift dramatically. The government's hidden lever to devalue the dollar might seem like a solution to national debt, but it could devastate your personal finances, leaving you scrambling to maintain your standard of living.
People holding gold would benefit. That'd be kind of the biggest beneficiary. Um, Most countries don't have an incentive to do that right now. So most countries, you know, if you kind of poll political leaders, most of them would not find it in their favor to do that. Um, it's also important to kind of talk about a couple different types of gold standards. So a true gold standard is generally like where, you know, the retail people using banks and stuff could redeem their currency for gold. So you have a lot of points of conversion to reinforce that gold peg, right? In over time, as you know, when you kind of saw the transition from gold standard to fiat standard, their gold holdings as a percentage of their monetary base or as a percentage of their M2 kept decreasing. So they would start to add more frictions for that redemption process. They say, look, you can redeem it, but only if you're going to do $1 million or more, right? Or they say you can redeem it, but only if you're foreign central banks or actually our own citizens, not really on a gold standard, but we're going to maintain this peg with international markets to kind of maintain the validity of this peg. There's kind of like different levels that it can go toward. One of the challenges, and I pointed this out in Broken Money, is that when you have a multi-layered banking system, so when you have a central banking system, like you have banks built on a central bank built on gold, the problem is that individual banks don't have any tether to that gold. So they're required to maintain a certain percentage of their reserves, of their assets and reserves, for example. They're required to maintain certain capital ratios, which could include reserves. But they can lend quite liberally. And when they lend, they create more M2 money supply. And the central bank is also fraction reserved. So they might have, you know, back in the old day, they might have 40% of their monetary base backed by gold. So you have M2, which might be 5-to-1 or 10-to-1 compared to the monetary base. And then the monetary base might only be 40% gold, for example, or less if they're running into a problem. And so there's multiple entities that when they lend, they're not even thinking about how much gold the sovereign's holding. It's just not their concern. And so you generally see an expansion of the money supply. There's no real kind of method to contain the money supply relative to the amount of gold when you have that multi-tiered system. And so I would argue that's why they all broke, is that they kind of shifted from, you know, back in a free banking environment where each individual bank has gold, or gold, you know, assets that could be liquefied into gold. They're making loans. They're trying to monitor their own reserves. But when you have that multi-tiered system, everyone's kind of removed from the problem. And so money supply tends to grow and proliferate, whereas gold reserves don't. So I think that if they were to try a gold standard, it'd be a big reset. But then over decades, you probably would break all those pegs again, because there's no firm tether between the amount of gold and overall loan creation. Notably, in the United States, there is, For example, if you look at the Fed's operating handbook, they have a mechanism for gold revaluation. It's actually initiated by the Treasury, not the Fed, but it involves operations between the Treasury and the Fed. And I mean, they could do a reset that doesn't involve going back on a gold standard. They can just they can increase the official dollar price of gold. And that's a mechanism where they would be able to get more money in their Treasury general accounts without associated increases in debt. And therefore, they could spend that into the economy without debt issuance. And so they could technically do a big, say, dollar devaluation relative to gold, and kind of reset a lot of debts. That's kind of one of the kind of the debt jubilee mechanisms that they technically have, although it'd be a huge political lever to pull should they do it. But it's actually there in their handbook. And again, it's different than going back on an actual gold standard, which would be that currencies are redeemable for gold. Like something like 90 years ago, so it used to be that the Fed held gold, and the Treasury said, look, we're going to hold the gold now. Instead, so the Fed had to give their gold to the Treasury, and in exchange, the Treasury gave the Fed gold certificates as an asset. It's mostly an accounting gimmick so that they don't have a hole in their balance sheet. But basically, they were non-redeemable gold certificates. So they're kind of saying, look, these don't really mean anything, but they're technically representing your ownership of gold held at the Treasury. What the mechanism can work, and that was at the official price at the time. And that price is, like $42 now. It was revalued once, but it's $42 now. It's way below the actual market price of gold. So what they could do, for example, is say, well, now the official price of gold is the market price, or you technically could go above the market price. And if that happens, the value of the Fed's gold certificates increase in dollar terms. So that's an asset for them. And they provide an associated liability for them in dollars in the Treasury's general account, which is an asset for them and a liability for the Fed. That's basically the government's checking account. And then what that allows them to do is they can then spend money into the economy that they did not issue bonds for, because instead they got that through gold revaluation. And that would generally be fairly inflationary. It probably would increase the price of gold if they were to do that. And so that's kind of the mechanism. They could also, they technically have kind of like how they can do open market operations with treasuries or mortgage-backed securities. They can do open market operations with gold. They can start creating reserves to buy gold. And of course that would generally decrease the value of the dollar, increase the value of gold. And so they have these kind of mechanisms that these levers they can pull that would, say, sharply devalue the dollar-based debts relative to gold, which means the reserves of central banks increase generally relative to their country's liabilities, which is denominated in dollars. It generally means that you get more inflation, more money supply growth in the U.S., and therefore various debtors would be partially relieved relative to their price of their nominal assets going up. So mostly in inflationary or stagflationary contexts, and there's a lot of nuance there. So basically, there's been 4 major inflationary decades in the Western world in, let's call it, the modern era, the oil era, for example. So the 1910s, the 1940s, the 1970s, and then to a lesser extent the 2000s. These were big energy bull markets. They were elevated inflation compared to the decade before them, and generally just elevated inflation in general. And so you generally had things like oil doing very well, commodities in general doing very well, gold and silver doing very well. And normally stocks and bonds as a group did not do particularly well in all 4 of those decades, especially in real terms, but generally even in nominal terms. So, for example, the bull market of stocks in the 2000s failed to kind of break out from the dot-com bubble highs, even 10 years later, for example. The markets in the 70s, the markets in the 40s, the markets in the 1910s, they were all weak in terms of stock market performance. And bonds also obviously did pretty poorly as well in those inflationary environments, especially if they entered them with fairly low yields, which was usually the case. And so during those decades where both stocks and bonds do poorly, the 60-40 portfolio is not very good. And instead, having some of those exposures to those commodity, energy, hard money assets historically would have been the diversifier you need in that decade if you wanted to have this kind of like passive rebalancing portfolio that is all weather. That's where those types of assets come in. For the commodity portion, commodities in general are not good performers. They tend to have like 2 bad decades and then 1 good decade, and then 2 bad decades and 1 good decade. But that good decade tends to be the one where stocks and bonds have a bad decade. And so it's a useful diversifier in that sense. And among commodities, gold has been one of the best performers. And also, energy producers have been good performers. Those are kind of methods to diversify a portfolio. And the inflation thing's tricky because, if inflation starts to get hot, but then the market says, well, the central bank's going to get very hawkish then, and they're going to quell the inflation, then in that particular year, gold might not rise. The higher real rates might deter people from buying gold because they're confident that, look, I know CPI is high, but the central bank's not on the case. Instead, where gold tends to go up is when money supply is increasing and inflation's building, but the central bank hasn't really acted yet, or they've tried to act and they've not really been able to contain it. Those are the scenarios where gold tends to do well in inflationary times. Gold can also do well in disinflationary times if you have a rapid fall in real rates. So, for example, in 2019, gold had a good year. Official kind of real rates in the U.S. went from positive to negative. We had an economic slowdown. Stocks were kind of chopping along, and gold did fairly well. It was a useful diversifier in that environment. So there's a number of different contexts where gold does well. But the really big picture view is that gold and similar assets tend to do well in decades where neither stocks or bonds do, which is, basically the commodity capex cycle has run its course. There's more scarcity. There's maybe more money printing happening, various kind of inflationary reasons. And that's where gold tends to be a useful diversifier.